G'day folks, welcome back to the Dynamic Investor Program video report for November. So this is to be viewed alongside the written report. Just a quick reminder that this is general advice only. You've all seen this disclaimer before, but I just need to reinforce again. We're providing a strategy and a framework and a portfolio, but at the end of the day you need to make your own judgments on what investments that you take. So just a bit of a quick market overview. As I've mentioned over the last couple of months, seasonally November and December tend to be the stronger months of the year. Not always, so we can't take that as a given, but certainly from a seasonal basis that's the case, certainly for stocks and quite often for precious metals, because this is certainly the strongest buying period of the year for precious metals. Now looking at Europe, to me, whilst there was a decision the weekend before last that was taken very positively by the market, to me the basic problem hasn't been resolved at all, and now there's a question mark already about where the funding is going to come from. China is not exactly playing ball at the moment, which I don't think they should either, because it would quite possibly just be another bad investment. So what's been resolved, I think, though, is that some time has been gained, and the short-term threat of a market crash and a market meltdown like we saw in 2008 has probably been removed now for at least a little while, probably at least a few months. The way gold responded last week, it was up $100 an ounce, so it's responding as though new money creation in some form or other is pretty much a given, and that's what I've been expecting all along. We look at China. There are now some signs of some easing in the lending restrictions. So I always thought China would do whatever they needed to do to keep their economy bubbling along. And I think people are less fearful of inflation than they are of some of the perhaps the worst effects of not keeping the stimulus going. But I also think people that are getting overly obsessed about a property bubble in China are also forgetting about the bigger picture. And the bigger picture is that 500 million extra people are moving into cities over the next 20 years, and they've got to be accommodated with obviously with housing, and that requires power stations, roads, bridges, and everything else that goes along with it. So I really think that any pitfalls that there are in China, which I'm sure there'll be some, will be relatively short-lived. Turning to America now, I believe QE3 is close, or it's already underway in a certain disguise. I know the Fed is buying up some mortgages again. There's some program for that to happen, so that in a sense is just another way of printing money. So that's going to be very positive for gold, and fundamentally, and these I think is pretty much what I had last month. Fundamentally, the picture for a massive move higher just gets stronger all the time for gold. Technically, we're on the verge of moving into this final leg, which will probably last for a few years. We saw a $100 gain last week, and so I think gold is probably based out. And of course the other part of it is gold stocks really are lagging behind the gold price substantially. So I think over the next 3 weeks, 3 months, 6 months, 12 months, we're going to see gold stocks significantly outperform gold. Now silver will outperform gold, and certainly gold was up 6% last week, last week, and gold was up by 12% last week. So it would appear that trend is already underway, and that silver has basically formed a base. Now the silver stocks, we've got limited ones to choose from in Australia. They're not really joining in as yet, so the silver ETF is really the only way to go at the moment. So just to reiterate the strategy, the overall exposure, I'm prepared to let that ratchet up to 60% maximum. So 60% in invested, 40% cash. And of the 60% maximum that we may work our way up to over the next couple of months if opportunities present, 2/3 of that I'd be looking for in precious metals exposure. So 40% of the total in precious metals and only 20% in other. Now, looking at specific stock selection, obviously gold producers are the number one on my agenda. I'm continuing to do the research that you've seen evidence of over the last couple of months, and I'm feeling very confident that I've got all of the potential good gold producers identified. I'm tracking them very closely, and there's not really going to be too much that's going to slip through under the radar. So it's really just a matter of buying when the price pulls back a bit, and I think that's going to prove to be a very good medium to long-term strategy. Obviously, some direct precious metals exposure via the ETFs is still on the cards, and we're also looking at the diversified resource majors as well, such as BHP and Rio. In addition, I'm also looking for high return on equity, high growth dividend paying stocks which can be bought at panic prices. Now, whether we get any panics in the next couple of months is an unknown at this stage, but again, as with the gold producers, I know exactly what it is I want to buy. I've got a list of stocks that really appeal, and if we can pick them up at lower prices, they're going to be terrific performers for us. Just through dividends alone, we won't need to rely too much on capital gain if we can buy in on a panic. So before I move on to an examination of the actual portfolio, that's the general part of the presentation. So for members now, I'll move on and cover the actual portfolio.